As the theme of today's conference is centered around the global tax roller coaster, our final panel will focus on tax reforms and policy changes that are happening around the world in selected jurisdictions and their reactions to U.S. tax reform. The panel will be chaired by Professor Georg Koffler with panelists Koon-Ming Ho, Alfonso Pallette, Chris Roberts, and Robert Vanderjagt. Professor George Koffler on the stool is a professor of law and head of the Institute for Fiscal Law, Tax Law, and Tax Policy at Johannes Kepler University of Linz, Austria, and currently serves as Global Professor of Law here at NYU Law School. Georg is a member of IFA's Permanent Scientific Committee. His research focuses on international and European direct tax law and all aspects of Austrian tax law. And from your left, Koon-Ming Ho is head of tax of KPMG Asia Pacific. In addition to advising on China tax planning for both inbound and outbound investments, Koon-Ming has also been involved in many tax policy consultation projects with treasuries and tax administrations, both inside China and outside China. Alfonso Pallette is head of KPMG Latin American's tax practice based in Miami. In this capacity, Alfonso brings to the panel a broad regional perspective from various countries within Latin America, hence the need for all of these foreign country flags. Chris Roberts is a senior member of KPMG UK's International Corporate Tax Practice. Currently, Chris leads a team of UK tax professionals based in the US. And Robert Vanderjagt is an international tax partner in the Dutch member firm of KPMG. As head of KPMG's European Tax Center in Amsterdam, Robert specializes in international and European tax law. Robert is a member of the Practice Council of the International Tax Program at NYU Law School. Professor Koffler.
Thank you very much, Larry. Thank you very much to all panelists for being here and for joining this panel with me. We have kind of a card game topic, whack-a-mole. So stuff that has already been beaten down like 10, 15 years, like the disclosure rules in Germany, they are popping up again. And I think we are seeing themes recurring, not only here in the US and on the international level, but also in individual countries. And this is how we have chosen the topics for today. We will first delve a little bit into the new mandatory disclosure rules that's based on Action 12 of the OECD BEPS project. And in the European Union now we have a mandatory directive on that. So member states will have to implement disclosure rules and this information will be exchanged automatically. And this will be our first topic and there are a lot of kind of also policy implications. Then of course, no international topic could move along without some discussion about Brexit because it also poses some broader issues. How will the global trade and the European trade be set up in the future? What are the tax implications of that? And then, of course, we kind of mirror what has been discussed during the day. There was a lot about the Trump reform, the DCJA here in the US, and we will take a look for two broad regions. One is LATAM and the other one is China, how countries and regions react to the US reform and what we will see kind of in terms of tax competition and also planning structures. And finally, we have chosen a topic that's going around a little bit. People find it incomprehensible, and I think we agree to a certain extent. The European Court of Justice has ruled on abuse cases with the basic question was, what does beneficial ownership mean in terms of holding and back-to-back holding structures and back-to-back loans? And we will kind of cover what the Court of Justice has held, because this will probably inform a lot of European general anti-avoidance rules as we move forward. It was not easy to identify 4 topics only. We had a couple of topics on our agenda when we moved into our telephone conferences. For example, this year is the first year that European Union countries have to implement main portions of the Anti-Tax Avoidance Directive, like interest barriers, CFC rules, and the GAR. Every European Union country now has a general anti-avoidance rule. Then also there has been this proposal on a digital services tax in the European Union, taxing basically a large mostly American-based multinationals with their advertising revenues and intermediation services. This has been defeated in the European Council in March of this year, but probably the political mission has been accomplished because now the OECD is really facing pressure and moving forward, so there's kind of also a big game going on there. There are two things that I am personally interested in, but we had to skip out. One is the European Union is working on a whistleblower directive, protecting whistleblowers from repressions on the workplace, but also in terms of litigation, and that would cover tax whistleblowing. So if an employee, for example, thinks that a company has too aggressive tax planning, the employee could blow the whistle and would be protected. So it goes very far in this area. And then, of course, we have a proposal on the table in the European Union for public country-by-country reporting, meaning that larger companies would have to disclose income tax information in their public accounts. So there are a lot of topics, and we have identified four of them, and I will hand over to the mandatory disclosure, I think one of the most pressing issues right now.
Yeah, thank you. The EU mandatory disclosure rules is the EU implementation of BEPS 12. And the same like the EU has done with ATAT, the intent was to have an EU-wide implementation of BEPS action points, so in this case BEPS 12. What is the purpose and the objective of these mandatory disclosure rules? It is to basically create a radar screen for tax authorities to spot new loopholes, new planning schemes. The way this has been designed is basically they use the fundamentals of the DOTAS regime in the UK, which was introduced in 2003. So it works with certain hallmarks. This is a pretty complex directive and possibly resulting in a haystack of reportings. This is not only going to affect European companies, but is also going to be very important for US multinationals. Why is it so complex? First of all, there's a deadline in which you need to report, and that deadline is only 30 days. The good news was that in the original draft, it was only 5 days. So we are extremely happy with the 30 days. There are also penalties. The directive itself, it doesn't give any guidance in terms of the penalties. It's up to the member state. But these penalties need to be proportionate and also dissuasive. So you have to look on a member state by member state basis how they are going to implement that. If we're going to look at the hallmarks, there are basically 5 categories which you can divide in 2 main categories. The first main category, that's what you see here on the screen. And those are the hallmarks which are subject to a so-called main benefit test, which means that even if you meet a hallmark, there's a second test that you need to pass, which is the main benefit test. So basically looking whether the main reason why you have set up an arrangement is to obtain a tax advantage. I don't have the time to go through all of the hallmarks, but you see them here on screen. And here you see the hallmarks which are not subject to the main benefit test. And if you were to ask me, where do you expect the most reportings to come? That's actually in the transfer pricing category. So that's category E. Let me just take one example. That is E3. That is the transfer of functions of risks or assets, which results in a reduction of EBIT of 50% or more over a period of 3 years. Just to give you an extreme example, let's say we were talking earlier today about IP onshoring. Let's say you have IP based in Bermuda, so there's no tax, and you onshore it to Germany or France or the Netherlands or Denmark. So you go from 0 tax to a normal tax rate. Well, that is, I think, the opposite of aggressive tax planning. And when I ask the audience normally in presentations like that, what is the opposite word of aggressive tax planning, the answer I usually get is stupid. So there doesn't seem to be another reasonable expression for that. So this example illustrates how wide the net is, because you have to report also arrangements that are not aggressive at all. That is the way it works. So some countries are really happy and they want to have a haystack of reportings. Other countries, they say, we're not so happy. Where is basically the headache of all of this? Well, with ATAD, we saw that most countries are more or less implementing this in a very similar way. But here, with the DAC 6, which is the BEPS 12 implementation, we're seeing a huge variety of implementation, and that makes it really complex. So if, for example, as a tax advisor based in the Netherlands, I cannot simply limit myself to looking at the Dutch rules only. So if I have an arrangement where the Netherlands, Germany, and Spain is involved, if the conclusion is that based on the Dutch implementation, I don't have a reporting obligation, that is not the end of the story. I still have to also look at, maybe I have a reporting obligation in Germany, or maybe I have a reporting obligation in Spain as well. And given the fact that the variations are pretty significant, that makes it complex. And I would say there's a platinum category of countries, and that currently is only one country, and that's Poland. And that even imposes an obligation on you as a US tax advisor, if you are involved in a cross-border arrangement for a client that includes Poland, you as a US advisor may have a reporting obligation in Poland. And the penalties in Poland are really, really severe, including imprisonment. Mm-hmm. So, yeah, that is in a nutshell. I mean, I can talk for hours about this, but if I've tried to do it in a few minutes, Georg.
Yeah, it's really extremely broad. For example, the D hallmarks are about private individual and tax evasion, so putting the bank accounts on the side. And it basically also implements the CRS avoidance discussion that the OECD is having. So if you build up a structure to avoid automatic exchange of information on your financials, that's covered by Hallmark D.
Absolutely.
And if we perhaps can switch to Hallmark B now that we have kind of a couple more minutes time, there is a hallmark that says conversion of income from a taxable category in an exempt category. So think about a typical structure that the parent has given a loan to the subsidiary and now forgives the loan. Then it kind of converts interest income into dividends, which would be covered by that hallmark. And that leads me to probably, if the main benefit test is full, leads me to two questions to you. So the first question is, and from a policy perspective, the idea is that tax administrations should get timely information about what's going on. So well before an audit, they should know what is basically going on in the tax planning area. Wouldn't this over-reporting completely defeat the purpose? Because this is something a tax administration must know, that you have sometimes zero withholding and sometimes participation exemption. So isn't the over-reporting already a problem by itself? And do you expect this list to be developed into the future and changed into the future as we move forward?
Yeah, we see various attitudes here. So for example, the Netherlands clearly says, and they've asked the tax authorities, what do you want to get out of this? And the Netherlands says, well, we would like to have the needles presented on the tray. Mm-hmm. We don't want to have the needles stuck in a haystack. France, on the other hand, said, we love haystacks. So the more we can teach the tax advisors, the better. So it's a difference that you see. In terms of future development, I think there are 2 points to realize. This is only the EU implementation of BEPS 12. So there are more countries to follow, And it could be that the EU, maybe through the blacklist, etc., is going to impose a sort of an obligation on other countries to also introduce this. We have to see how that evolves. Secondly, the European Parliament is pushing for a change of DAC 6. Now it is only, in terms of the scope, cross-border arrangements. So it needs to be international. So there need to be at least 2 countries involved. The European Parliament would like to change it in a way that also domestic, so purely national arrangements are included as well. I do expect that in the next few years, we do see an expansion of DAC 6.
I mean, we have seen it in Germany. Usually countries which have coalition governments try to avoid gold plating. Gold plating means that you over-implement European Union law, but rather limit yourself to implement just what the EU requires you to do. And Germany has done some gold plating. They've implemented a DAC 6 to also cover reporting on domestic transactions. So it goes into this kind of discussion that we see in Parliament.
Yeah, so Sweden has done it as well. So we have basically 3 categories. There's the category 1, those countries that stay closely aligned to the directive, so no gold-plated version. Then we have category 2, Sweden, Germany. So they have certain add-ons. And then we have the platinum category, that's Poland.
Okay, so we still have time. So one point that's kind of puzzling many people, and that is also relevant for the US. The directive is extremely vague on who has the obligation to report. And you can have multiple people obliged to report a single transaction if, for example, you have advisors in many European countries on working on one transaction. And even anybody who is involved in the transaction is a person, a so-called intermediary, who is obliged to report. For example, you're a law firm, you're a client, and you have a bank. All 3 of them might likely be reportable persons. And then some countries have an exception because they rely on their professional privilege for tax advisors or lawyers, for example. So the reporting obligation jumps over to the taxpayer. And the taxpayer might likely ask the advisor again to prepare the report. But I mean, we have a broad scale. And I am not sure, so in Austria and also Germany, it was quite unclear how far you can stretch the notion of an intermediary. Would it be only the bank, or would it also be somebody who provides an expert opinion, whom you ask just a small portion of the case? So it's very unclear who is reportable. I mean, countries have to resolve it, and I think there is no clear-cut solution. Right?
Yeah, and again, there it is the local country implementation of DAC 6. So it's this extreme variation of interpretation. And we've been begging the European Commission, give more guidance. But it won't happen because the European Commission doesn't have the authority to give any guidance. The only institution in the EU that is allowed to give interpretation to this directive is the European Court of Justice, which means that you have to litigate. Yeah, so it's rather complex.
Okay. Which is basically probably the end of this part, because we move from one uncertainty to the next one, and I might ask Chris to give a little input on the Brexit and its tax implications.
Yeah, thank you very much. I guess anybody thinking that we're going to get rid of DAC 6 simply because we're leaving the EU is sadly mistaken. So the UK is going to be stuck both with its DOTAS rules and also with DAC 6. There's no sign of us getting rid of that as a result of Brexit. So the current position, if I can call it that, is set out on the screen. So we had our vote back in 2016. We were all ready to leave at the end of March this year, and then the government couldn't get its act together, and so we ended up with a false start, a push back to the 12th of April, loads of indicative votes in Parliament. So for those of you out there who are interested in UK politics, it was a really interesting time as to what was happening. Did it actually mean anything? Who was this Speaker of the House who was shouting a lot and getting the government to change their mind? And we've ended up in a position where we've had another delay, and hence the series of question marks there. At the moment, the plan is that we remain within the EU up until the 31st of October 2019, unless we agree to the exit deal before then. And from what we hear in the UK, there's a lot of action going on, because the real deadline for us is that we, the government, really do not want to take part in the European parliamentary elections, which take place in the UK on the 23rd of January. So you have this situation in the United Kingdom at the moment where we've got the governing party, the various parties getting ready for the European parliamentary elections, putting candidates forward, but we don't know if we'll actually be taking part in those. If we don't take part in those elections on the 23rd of May, and we haven't ratified our exit agreement before that time, then we fall out on the 1st of June. So the chances of a no-deal exit are still very real. There's talk of Theresa May putting her agreement back for a meaningful vote for. Question mark over whether or not that will actually get anywhere and will end up leaving the European Union, or whether things will be extended to the end of October and we'll just end up in the same position then. So the politics are, I would say, finely balanced. They are finely balanced. There's discussion going on between the ruling Conservative Party at the moment and the Labour Party around what they can agree on to maybe shift the needle to get a deal agreed. But that will very much, I think, depend on the Conservative Party giving up on some of its red lines, which are wholly inconsistent with what the Labour Party wants. So, I guess more uncertainty for business, more uncertainty for those of us. Well, I don't live in the UK at the moment. I'm living here, so I'm okay. But for my family back home, will they fall out at the end of October? Will it be a really scary Halloween for them, or will everything be all right? And will have either remain within the European Union or will have come out with a deal?
What is your expectation?
My expectation is there'll be some form of deal, but it'll probably be a long way from the existing, or what Theresa May wants at the moment. I think she'll be forced to compromise on it. I think, it's a mess from my perspective as a Brit looking inwards on it. And I think, something will have to change, whether that's a change in Prime Minister, whether that's a general election, whether it's another referendum, kind of who knows, but my money is probably on a deal. I think the key thing for the audience here to note is that this deal is just simply so that we maintain the status quo to the end of December 2020. So it means that we're still treated as a member of the European Union for all purposes up until the date we actually drop out once we've agreed a future trading relationship with the EU. So this is not what it looks like going forward. This is just maintaining a status quo. So I thought what we talk about very briefly is some of the tax implications of Brexit. And these are kind of prefaced on a no-deal outcome, or a deal outcome, but one where we look forward to the end of 2020, what the future might look like and what some of the implications will be for business. So the direct implications are relatively straightforward if you ignore what might happen to companies' profits, etc., as a result of Brexit. So the first one, our access to the directives might be limited. So we have the EU Interest and Royalties Directive, and we have the EU Parent Subsidiary Directive. So they remove withholding taxes on flows of interest, royalties, and dividends, from EU subsidiaries to the UK, and vice versa in the case of Interest and Royalties Directive, and from a Parent Subsidiary Directive remove the right of, say, Italy and Germany to levy withholding tax on dividends. If you're looking the other way around, so UK outbound payments, so the UK has announced that its existing implementation of the EU Interest and Royalties Directive will continue to apply, so there should be zero withholding tax on payments of interest and royalties outside of the UK where the conditions for the EU Interest and Royalties Directive would have been met. And for EU Parent Subsidiary Directive, well, the UK doesn't levy a withholding tax on dividends in any case, so that one wasn't really relevant. The third implication on there is around domestic law tax groupings. So in the case of you've got a UK parent company, a common parent company for two French entities, and they're currently tax grouped in France, if we drop out of the EU without a deal, or we don't get access to something that looks like the existing EU arrangements going forward, then there'll be an inability to tax group within the EU for those two entities, within France for those two entities. And then finally, access to US treaty benefits. So a number of most US treaties have a limitation of benefits clause that we're all familiar with. And an example where you're relying on the parent company being resident in an EU member state and listed on a recognised stock exchange. If the UK falls out of the European Union, it's no longer a member of the EU, obviously, and therefore if you're relying on that listed exemption in the LOB to get a 0% US withholding tax on interest payments, for example, to Luxembourg, then that would fall away. So the key messages on direct tax are assess your group structure, assess your potential exposure and possible tax leakage. Can you look at restructuring options? Restructuring options as a result of having withholding tax where you didn't have it before. But obviously you need to think about some of the things we've already talked about today. So treaty shopping, EU directive shopping, principal purpose tests, beneficial ownership that Robert will talk about later on. And then also on your restructuring options, you need to think about, are you trying to benefit from an EU directive to achieve a tax neutral restructuring? And how long have you got to actually implement that? Secondly, just going to briefly touch on the VAT implications. So the current position on the left-hand side, no VAT charged on outbound supply of imports of goods to the UK by an EU supplier. The UK customer accounts for VAT under the reverse charge mechanism. On a no-deal basis, the UK has unilaterally announced that it will introduce postponed accounting, so there's no need to account for input tax on the imports into the UK immediately as soon as they cross the border. You'll account for them through your VAT return, but there will be a change to low-value consignment relief. So if you're importing goods of a low value into the UK, currently there's no obligation to account for VAT on those. That will be removed, and the UK is going to introduce a unilateral measure to account for VAT essentially on those goods. Exports from the UK is exactly the opposite of that, but it very much depends on the other 27 member states taking the same actions as the UK. So in terms of an export from the UK, say to France, will the French view that as an immediate import and require import VAT to be charged and paid as soon as the goods cross into France? Or will they implement some kind of deferment mechanism? And on distance selling, again, will the EU maintain its current rules, so allow UK companies not to have to charge VAT over in those territories or apply the mini one-stop shop? Or will they introduce new filing requirements, new obligations? Thirdly, we've got customs duty and Brexit. So obviously, on the top left-hand side, you've got a picture of Europe, which is a happy one, where the UK remains in green, part of the European Union. And in the bottom left, you've got, depending on what your politics are, a not-so-happy picture where the UK is coloured in yellow and outside of the European Union. So under a no-deal scenario, that means we revert to World Trade Organization rules. It means new duties on goods coming into the UK, on exports from the UK. What the UK has announced it's going to do is to cut tariffs unilaterally to 0% for the majority of imports of goods to the UK. And by value, that is around 87% of goods coming into the UK. The tariffs will be cut to 0. What that will do is obviously lower costs for consumers in the UK, but expose UK businesses to competition from imports. I think secondly, one of the more important implications of that is it will deprive the UK of a bargaining tool in trade negotiations with third countries like the United States. So if we're willing to cut tariff barriers to 0, what does that mean when we go into negotiate with the US and other territories on bilateral trading agreements? And then finally, what is the impact for Northern Ireland of that cut to 0%? The UK at the moment has said that they will maintain 0% on all goods for goods moving between Ireland and Northern Ireland, but how is that consistent with having the UK and Northern Ireland as one country, with not having a hard border in the North Sea? I think they need to put some thought into that. So finally, some of the indirect tax key measures as to what we're recommending for our clients, what we're talking to them about. You need to assess your supply chain, assess where you've got risk, where you've got increased cost coming around as a result of Brexit. Whether you can look at duty deferment schemes, which will obviously defer the payment of duty on imports into the UK and potentially exports out of the UK. Look at authorised economic operator, AEO status. So this I like to think of as the TSA pre-check line. If you're going through security at a US airport, it's the kind of trusted trader. You can go through that. It's a faster queue, it's a shorter queue sometimes, but it can get you through there. Looking at inward processing relief and other reliefs, and looking at customs warehousing. And then KPMG has developed a Brexit tool which you can use as a business to assess your exposure to increased costs from a duty perspective, from an administrative and compliance perspective, and potentially from a cash flow perspective on indirect taxes as well. I mean, before we go on, there's obviously a lot more implications of Brexit, which I can talk about for hours, including from a people perspective, from a supply chain and regulatory perspective, but this is just some of the flavour of where we might end up with from a tax perspective.
Thank you very much. So at one point I would like to add before I have a question for basically the Europeans on the panel. So other countries have reacted in the meantime because this uncertainty kind of drives business in other member states kind of crazy. So Austria, Germany, some other countries have enacted no-deal Brexit acts. And those acts basically deal with what do you do with exit taxes where you have an installment payment plan for exits to the UK. And this is something that we are required to have under EU case law. So will these installments be immediately payable once the UK exits or Brexits? Secondly, there has been a regular company law, case law, which requires one member state to recognize the legal forms created in other member states. For example, as an Austrian or German, you can create a UK limited and do business in Austria or Germany with it. You wouldn't be able to do that under domestic company law if you were outside the union, because this would require management in the country under company law. So we have a lot of UK limiteds around, and all those would lose their protection based on Brexit. So countries have reacted and put regulations in place by saying, okay, you can leave, you can stay in that form for a certain amount of time, and then you have to restructure. So kind of a lot of taxpayer, I would say rather taxpayer or business-friendly reactions to this increasing uncertainty around Brexit. And that's my question. Now, let's assume all the dust settles. I assume that there is a Brexit going to happen and no second referendum, so no glimmer of hope. What will the UK do in terms of tax competition? Will it be like Singapore or some other kind of ramp it up and say, no, we are not bound by state aid rules anymore, so we offer ourselves as we couldn't do it before? Or will the UK remain a rather high-tax, business-friendly environment like before? So is there any idea that you have?
Yeah, if you look at the withdrawal agreement that has been agreed between the UK and the EU negotiation team, that's a 586-page thick document. And there's a section especially addressing these concerns raised by you, because obviously the UK, of the EU, all the member states are very afraid that the UK is going to do cherry picking. So they could position themselves, as you rightly say, becoming the Singapore on the Thames, with low tax rates, giving state aid. Setting low tax rates, that's something that the EU cannot prohibit, because we have low tax rates in certain EU member states as well. So that's a possibility. But state aid, that is specifically arranged for and provided for in the withdrawal agreement. So in case of a soft Brexit, the UK doesn't have the flexibility or the freedom to position itself as the Singapore on the Thames, except for with low tax rates it's possible. If it's a hard Brexit, then there's no agreement, the withdrawal agreement doesn't apply, then the UK is not bound by such rules. But we know we have a blacklist in the EU. So the EU is powerful enough to put a gun on our friend's head and say, guys, this is unacceptable. So I don't see much flexibility for the UK, both in a soft case Brexit or in a hard cliff edge scenario Brexit.
The UK could sail in the kind of wind shadow of the US in this respect. I mean, I think the EU wouldn't dare to put the US on the blacklist. So I see some political limits to that. Yeah. Excellent. Now that we have kind of touched on the US a little bit, I would ask Kunming to give us some input from a Chinese perspective, what the reactions are on the US reform.
On the US?
Yeah.
Well, I think not just on the US, on the changes in the global tax landscape. I think you asked me during our call in preparation for this panel is what's the single most important effects of all these global changes on China would be. My answer to that is that, ironically, all these changes actually would speed up the domestic economic reforms in China, which in the long run would actually strengthen China's position as an economic world power, which not necessarily the intention of the jurisdiction which have initiated those changes now. The reason why this would accelerate the economic reform in China is that because all these changes would give the central government of China the tools to push through a lot of economic reforms that would otherwise could be hampered by localisms and regionalism within China. So the effects are going to be very positive in the long run for China, And the economic reforms that China is going to put through are about global competitiveness, about technology, about the growth of personal consumption as opposed to public investment by the Chinese government, about the growth of the private sectors as opposed to state-owned enterprises. And so, the effects actually has a lot of linkage with a very deep-rooted sentiment in this psyche of the Chinese population. That is, what doesn't kill you makes you stronger. So sitting in where I am, that is in Beijing, the epicenter of Chinese politics, I can sense that the mood among the Chinese politicians, among the Chinese officials and the people is one of excitement, albeit angst-fused, is one of anticipation, one of readiness to take up the challenges the rest of the world, including the US, impose on China. And it is not the first time, indeed, China actually have to deal with changes that happen globally. In recent time, China, almost 20 years ago, had to deal with those changes when China acceded to the World Trade Organization, WTO. And that process has continued with BEPS, has continued with the US tax reform, will continue with the project on digital economy sponsored by G20 and OECD. So this time round, China has adopted a three-pronged approach in dealing with all these changes. Firstly, to encourage domestic consumption. Secondly, to encourage domestic investment. And thirdly, to encourage Chinese businesses to move up the value chain on a global basis. So as far as the encouraging of domestic consumption is concerned, Chinese government has reduced the VAT rate from 17% to 13% in many cases, and 9% in some cases, starting from 1st of April this year, beginning of this month. This is a very big deal because based on the statistic released by the government for 2018, indirect tax revenue represent more than 55% of the total tax revenue of China, whereas corporate income tax only accounted for 22% of the total revenue, of which, based on our estimate, only about 8% was directly related to international taxation. So therefore, in today's symposium, why we are getting engrossed with the technical intricacies of all these changes in international rules in the context of BEPS, in the context of digital economy, when we assess, as far as China is concerned, while the effects of these changes is not to be sniffed at, it's by no means preponderant in the whole scheme of things. So it's important to bear that in mind when, especially in the US, where there is no indirect taxes, to have that perspective. And also, as far as encouraging of domestic investment is concerned, the Chinese government has introduced exemption on withholding tax on dividends that destined for investment, reinvestment in China. And Chinese government also rolled out a raft of enhanced R&D incentives, such that the bonus deduction on R&D has been increased from 50% to 75%. And it is also important to note that the Chinese government has no big appetite for a wholesale across-the-board reduction in statutory corporate income tax rate, which stand at 25% at the moment, because it's generally felt that taking into account all these extra incentives that have been introduced in China and taking into account the non-deductibles that exist in the US tax system, the effective tax rate between China and the US should be quite comparable. So as far as the encouraging of Chinese corporation moving up the value chain is concerned, the Chinese government has provided enhanced R&D incentives to companies, including both foreign investor enterprises and Chinese domestic enterprises that are involved in what we call the advanced manufacturing under the banner of Made in China 2025. And then Chinese government also encouraged companies to actually shift some of the relatively low-end operation to emerging markets, especially Asia Pacific, notably Indonesia, Malaysia, Philippines, Thailand, Vietnam, and Bangladesh. So these are the three key prongs in Chinese approach in dealing with all changes. Now, despite all these domestic measures and countermeasures in the face of changes, I think it is important to bear in mind that China is a big believer in multilateralism. China has been very actively participating in the developments of global tax policy, especially those sponsored by intergovernmental bodies such as OECD and G20, notably the BEPS and the digital economy projects. And also, it is also important to note that while China and the US have been portrayed by the general press as being at loggerheads with each other in many areas of geopolitics, when it comes to fiscal policy, actually China and the US are not necessarily antagonistic towards each other. A very good example is that in the current digital economy project, China positions is actually quite aligned with the US when it's come to the idea of marketing intangible in Pillar 1 of the digital economy project. And so above all, I'd like to repeat the fact that China is a big believer in multilateralism. And also China has been very actively looking for the balance, the elusive balance between the protection of national interests and also the advancements of the common good for the world as a whole. Thank you.
Thank you very much. I think now it's really interesting to see the reactions on the other side of the world in the LATAM region. What's going on there?
Thank you. And Larry, when you asked me about the flags, I didn't know you were going to actually bring all the flags of the countries that I mentioned. Thank you for that. Now I need to cover all of them to make sure. So the challenge when we talk about Latin America is there's no common body like in the European Union giving some directives. There is, like in every region, many factors that impact the tax policies, such as the different level of development of the economies, the different changes in government, and their own agendas. And that, of course, impacts heavily into the tax policies. For example, even in a sub-region such as Central America, you have different agendas when it comes to following BEPS or OECD guidelines in Panama because of what we all know happened compared to El Salvador, which is far behind in really actually embracing those measures. But in order to give an overview of the region and really to better understand how all this is impacting, just starting by saying which countries are OECD members. We have Mexico, who joined in '94, Chile, who joined in 2010, and then most recently, Colombia, who joined in 2018. And you're going to see in the future slides how that plays out in how the BEPS action plans is developing in the local jurisdictions with the different tax reforms. You have Brazil. Everybody will be asking themselves, Brazil since 2007 has become what is called a key partner, but interesting enough, did not subscribe the MLI. It's the big jurisdiction that's always not included in this kind of initiatives. Going back to the MLI, we had, in addition to the OECD members who subscribed it, we had Costa Rica, which is in the accession process as well to the OECD, Uruguay, and at a later stage in 2018, Panama and Peru subscribed the MLI as well. So what does that mean? What are the trends that we see? And again, we'll get in some details per country. So the digital economy being a strong focus in the different countries, and as in everything else, becomes a challenge for multinationals operating at a regional level, because the interpretation and the development of the local, under the local legislation of the different rules do not follow a same path. So operating in at a regional level becomes challenging because the rules they're implementing in Uruguay are different to the approach they have in Argentina, for example. And then clients really come to us saying, I really want to approach the region and be compliant. You need to help me navigate. And it's almost on a country basis to see how I can fulfill that. And some of the countries, going back to the example, because it was recently implemented, Uruguay actually drafted some digital economy measures that included corporate tax and VAT, and opened up for big companies to suggest approaches to be compliant. We actually help a few clients really giving that feedback before the legislation was enacted. And the approach is always, we want to be compliant. In that cases, when I said we help clients from the digital economy as well as credit cards, which are in the middle of it in most cases, like for example, and we'll go through that in Costa Rica right now, which comes saying, they're asking me to be the collecting agent, believing that I have more information, access to more information maybe that I really have access to. So you would see that digital and new compliance or registration rules are linked to each other, which is the development of new rules become a complexity to be compliant for the clients. And in some cases, it's not order to know the rule, but sometimes the rules are enacted without very much clarification about how to be compliant with it. The third bucket you would see there is direct and indirect transfer of shares. We've seen a tendency in countries adjusting the local legislation to actually tax the capital gains when they transfer indirect taxes. And maybe the fourth one, which is not included over there, would be the incorporation in local legislations more and more of blacklist and tax haven list and what it implies. But now, in order to approach this, and you'll see there's 2 slides with the countries, again, and in order to be able to face this, I'll start with the OECD members. And Mexico, again, joined in '94. Mexico had a very deep tax reform in 2014, which included many new international tax rules that could be identified with the BEPS action plan, anti-hybrid rules, non-deductibility of payments to non-tax jurisdictions, for example, and ThinCap rules, among others. So Mexico was really in the forefront back in 2004. You will see the main difference with the other countries is that there hasn't been a major tax reform in Mexico since then. We're expecting a new one, hopefully soon. I don't know, hopefully, but soon. And the reason is when this one was enacted, it was such a big change for Mexican multinationals that the agreement of the government was there was not going to be a major tax reform until 2018. Moving on to Chile, Chile implemented very strict anti-abuse rules, and LOB clauses are now introduced in the new treaties and also are applying local legislation, which for those of you who operate in the region are familiar to Chile not applying the lower withholding tax on treaties when you distribute dividends. But that changed with the tax reform in 2016. So now, if you invest in Chile through a treaty jurisdiction compared to a non-treaty jurisdiction, your corporate tax may change. So that's why the anti-abuse clauses, LOB, and beneficial ownership of Chile becomes so important. The third member, to go through quickly, Colombia, also enacting, and the most recent members who joined in 2018, several rules that follow the OECD BEPS action plan. I would say it's hard to follow in Colombia. When I talk about Latin America, in the US we always said tax reform, it took over 30 years to have a major tax reform in the US. In Colombia, they have one every 2 years. And I'm not kidding, it was 2012, 14, 16, and now 18. And so pieces here and there, they have implemented different ones. I would say they've included it, again, also tax haven list. They've included withholding tax on dividends. They're more strict on ThinCap rules, which is the big change that happened in 2018. They went from a 3-to-1 ratio to 2-to-1, but they included clauses for back-to-back loans with banks where the bank is actually responsible declare or say if there is a related party behind that loan. So Colombia also following very closely. And before I run out of time, on digital economy and some others, I would say there is the larger economies that I cover, and then there's also the smaller economies that also have some regimes that could be seen from an OECD perspective as, abusive. I briefly touched on Panama, but Uruguay and others not only are adapting some measures on tax haven jurisdictions, et cetera, but also reviewing their internal legislation about, for example, in Uruguay, they have a very favorable IP regime, and they're reviewing that in order to be more compliant. Interesting enough, and going back to how the different countries pick and choose, that if you would just review literally the definition to fall on the low tax or tax haven list in Uruguay, Uruguay would fall until that definition. And Paraguay, which is not on the list, would fall as well, because it's a brother country, but Panama doesn't. So for example, right now, if you were operate in Uruguay through a principal in Panama, because it's in that list, the goods that are sold in Uruguay would be taxed, even if they're through the principal, at a 50% rate of the corporate tax rate in Uruguay, so 12%, because it is in that list. So I'm running out of time, many countries, many flags to cover, Larry. So the idea is it is complex, but you can really see the tendency in the major jurisdictions, not only the OECD members, in implementing those rules in local legislation.
Thank you very much. Could you just click 2 slides forward? Because we will add to the next topic, to the beneficial owners, because then we can simply, Robert, cover this. Well, let me get the. There we go. Next. Yes. Then we spent like 2 or 3 minutes on the final case before we take questions from the audience very briefly. This case will kind of haunt you a little bit if you go to the international conferences this year, because this is really huge. You know, in the European Union, we have 2 directives, which have already been mentioned around Brexit. One is parent subsidiary for dividends, and the other one is interest royalties for interest and royalties, of course. And both of them work only in the European Union between qualified companies, and both of them foresee a 0 withholding tax. So if you have a qualified distribution or qualified interest payment in the European Union, 0 withholding. And here we all have Danish subsidiaries at the bottom paying up either dividends or interest payments. And in the middle, we have qualifying EU companies. And on top, we all have third country, either funds or corporations. And the questions, and all those companies have been interposed, as the Danish authorities said, largely for tax reasons, of course. So the question came to the court, is this interposition of seemingly qualifying European entities abusive in the sense that it violates either the beneficial ownership requirement or the inherent principle of anti-abuse that we have in the European Union? And the European Court of Justice, in its grand chamber, which is basically putting the landmark decisions out there, said, well, we don't solve the case for you, Danish court, which asked me, but we give you some guidance. And the European Court of Justice said, well, we have this general principle of EU law. It's unwritten, undefined, basically, and this can be invoked to counter abusive structures. And then it also gave some further guidance on a Luxembourgish SICA, so a lot of little details. But Robert, I think the main question is, what kind of conclusions can we draw from the abuse notions that the court has put out in this case?
Yeah, so it is indeed a landmark ruling. I put it in the row of Cadbury Schweppes and Marks and Spencers. I think the Court of Justice has basically introduced sort of BEPS concept. So the European Court of Justice has listened to, the world is changing. There's an international tax debate, and they thought we also need to make our contribution. So you could say the Court of Justice of the EU has gone BEPS. So it's an introduction, to put it in a few words, of a principal purpose test. And then, the question is, when does this principal purpose test apply? Well, you need to have a sort of a wholly artificial arrangement, which goes against the spirit and the objective and the purpose of the legislation at stake. The question arises, and I think we have some questions here, how far going are these cases? It's a little bit difficult to answer. So would it, for example, also apply to a tax treaty between two member states? The court seems to say, well, you need to take and use advantage, so there needs to be a link with EU law. So in the Danish cases, clearly, these companies, they wanted to take benefit of the EU parent subsidiary and the interest and royalties directive. So that's a very clear link with taking advantage of EU law. In the case of double tax treaties between EU member states, the question is, do you take advantage of something that is provided by EU law? Maybe in some cases you can, or in some cases you cannot. Some people have also asked, well, is this sort of, I mean, we have the PPT in the MLI, so for those treaties where the MLI will not apply, does this landmark decision impose a PPT on those treaties? Well, in case it is with a third country outside the EU, I would say very likely not, because you don't take advantage of EU law. Also, the question is, well, I don't have an anti-abuse provision in my domestic legislation. Does this landmark ruling override domestic law, and does it introduce and force you to use this anti-abuse concept introduced by the European Court of Justice? There the answer is yes. So the question that you have not, that you don't have an anti-abuse concept in your domestic law, that's not a problem. You have to apply that. But do you also have to apply it in a purely domestic case? I think not, because again, you need to take advantage and you need to abuse an advantage that is given by EU law. And what happens if a member state were to decide, well, in principle, this is abuse of law in the view of the guidance given by the European Court of Justice, but what happens if I don't apply that? Is that illegal state aid? Yeah, also I would say an interesting question, a complex question. So lots of questions, but I must say that the Court of Justice has given quite extensive guidance. But again, as you say, it's up to the national court on a case-by-case basis to decide whether it's abuse of law or not. So it could very well be that in certain countries it's applied in a more progressive way than in other member states. So there could be some variation. And what is the practical consequence for multinationals? I think, well, we saw these structures here on the chart. So anywhere where you have interposed an intermediary company in order to benefit from a lower withholding tax rate based on these directives, you need to scrutinize it. You need to examine whether you are at danger or at risk or not. And maybe a last question is, let's say if the intermediate company that you have imposed doesn't provide for a benefit, because if you would have done it in a direct way, you would have received the benefit as well. Is that abuse or not? I think the answer is not. But again, we're not sure.
Thank you very much. That is a really interesting case, and you will see a lot of it if you follow European and international developments. We would have a Q&A, but I think Larry is already looking at his on watch. But are there any pressing questions on any of the topics that we have covered? Okay, which brings us, thank you very much, brings us completely perfectly back into time. Thank you very much. Thank you very much for the panel being here.
Thank you, Professor Koffler, Kunming, Alfonso, Chris, and Robert. Well, we've covered a lot of ground today addressing the global tax roller coaster and hope that you've enjoyed the ride. We trust that the sessions were helpful in understanding the policy implications of global tax reform and where the future of international tax may land, at least directionally. What is clear, I think, is at least for now and the near term, is a global tax environment that will continue to be riddled with complexity, uncertainty, and instability. This 19th annual symposium has been an outstanding event with a record registration count and an all-star cast. 2 reminders, please return any handheld polling devices you may still have. If you have evaluation forms, submit those, and if you wish to claim CLE credits, please don't forget to submit your name tag in the basket designated for CLE credits. In closing, please join me in thanking each of our distinguished speakers who presented today, and thanks to each of you for attending the 19th annual NYU KPMG Tax Symposium. I look forward to seeing you all next year. Thank you.